Hey everyone, this is Libertarian Black Man. America's economy has changed a lot over the past century, and in many ways for the better. Our standard of living is much higher now than it has ever been in human history, and we've made a lot of that progress over the past century. We have goods and services that enhance our quality of life that we couldn't even imagine having a century ago. We live longer, and we do not suffer from a lot of problems as far as disease and food shortages and many other things that just made life more miserable for us a century ago. So we have progressed a lot over the past century, but that is where the good news ends, because in fact we have been progressing at a slower and slower rate. We do not make the kind of progress in our standard of living as we used to make. And I'm going to compare two different decades, a century apart, to show you just how far our economy has descended into stagnation. I want us to look at the 1900s and how we were economically back then and compare that to the 2000s. So in the 1900s, we had three recessions. One in 1900, one in 1902, and one in 1907. If you add up the time we were in recession during the decade, that was about 4 years. And you can look at the numbers from the National Bureau of Economic Research, which publishes those numbers, to find that out. The unemployment rate in the 1900s was far better than the next decade that I'm going to talk about. Unemployment actually got down to 0.8% in 1906. That is not only the lowest level for the decade, that is the lowest level ever seen in American history. The unemployment rate peaked during a recession in 1908 at 8.5%, the all-time high for that decade. And if you average up the unemployment rate for the entire decade, it was about 3.6%. Once again, you can go to the National Bureau of Economic Research document talking about unemployment annual averages during the first half of the 20th century, and you can find all those numbers out. If you look at how much inflation we had, it was only about 2.4% per year if you look at commodity prices and housing prices. Keep in mind, inflation is not a good thing for your standard of living. It means it costs you more to live, and you have to earn more money in order to keep up with the cost of living. Otherwise, then your standard of living will go down because your income will not be sufficient to maintain your standard of living. So 2.4% average per year. And you can check out the U.S. Census document, Historical Statistics of the United States from 1789 to 1945, to check those numbers out. All available on the web. Also, to look at housing inflation during that time, there's an index called the Case-Shiller Home Price Index, which you can that's produced by Robert Shiller, a Nobel Prize winning economist. And he has those numbers going back, home price numbers going back to 1890 to check out home price inflation. If you look at income growth during the 1900s, gross wages went up 32%. What is most important is not the gross wage, but the net wage. That's the amount of money that you are able to put in the bank, because you do have taxes and you have inflation that will eat into your income. So the amount of money left over after taxes and inflation is your net income, and that increased 8% during the 1900s. GDP growth after inflation was averaging more than 5% per year for the decade. If you look at the growth of lifespans, we had 4.2% growth during the decade. So people in 1900 were living on average to be 48.2 years old, and by 1909 people were living to be 50.2 years old. So an increase of 4.2% in life expectancy during the 1900s. The size of government We had 7 of the departments that we have today. We only had 7 government federal departments. The federal budget was $693.7 million in 1909, which was only about 2% of GDP. The national debt was a little more than $1 billion by 1910. That was only about 5% of GDP. Once again, these are numbers that you can check out, do a little research. The Cato Institute publishes, among many other organizations, they publish this information where you can see federal spending all the way back from 1790 to today. And you can see federal debt as a percentage of GDP going back to 1790 all the way to today. So these numbers are available for anyone who wants to see them. Other facts during the 1900s that we should take note of is that we had a gold standard which protected the value of our money. Our government was not allowed to print money above and beyond the amount of gold it had. So the gold standard controlled inflation. We had no central bank, no Federal Reserve, no income tax, and no estate tax to take people's money. So people actually were able to keep much more of their own money, and we had a lot of economic growth during the decade as a result. And the money kept its value, which also encourages investment in the private sector. Now, if we fast forward a century to the 2000s, you're going to see how these numbers have deteriorated and why we actually should be ashamed at how our economy has gone in terms of the direction of the level of growth it has seen. During the 2000s, we had only 2 downturns, only 2 recessions, one in 2001 and one in 2007. If you add up the time we were in recession in both periods, it was only about 2 years. Half of the time that we were in recession during the 1900s. That might look like good news because we were out of recession. We were not in recession as long as we were in the 1900s. But that is a deception to think that the recession was a period of recession was a negative, because in fact recessions help boost the economy. They help reset the economy for growth. And we had fewer recessions, but it ended up in manifesting itself in less growth. If you look at unemployment, well, we had the lowest unemployment rate was 3.8% in 2000 for the decade. 3 full percentage points above what it was at the lowest point in the 1900s. It reached a high of 10% in 2009 because of the Great Recession, and 5.4% was the average rate of unemployment, as opposed to 3.8% in the 1900s. It averaged 5.4% during the 2000s. Inflation was 4.3% per year. The more inflation you have, the less economic growth you're going to have, because the less investment you have, and you don't have investment. If people are saving less money, then you're going to have less investment, because investment comes from savings. 2.4% in the 1900s, 4.3% in the 2000s. And once again, you can just look at the information. The producer price index shows you what the inflation rate was. This is the period of the 2000s where the line is going sharply upward, and it comes down because of the Great Recession, which is why recessions are a good thing when you have too much inflation, because they kill off the inflation. But this is, again, numbers that you can look at if you want to have verification on how much inflation we had. Income growth during the 2000s. Gross wages only grew 17%, but once again, the real number to look at is the net wage. That actually, if you look at commodity prices and housing prices, net wages actually fell 26%. Wages went down significantly as opposed to going up during the 1900s. GDP averaged only 1.9%. We're talking about less than half of what it was a century earlier. 1.9% growth in the economy per year on average during the 2000s. Once again, you can go to the Bureau of National Research, Bureau of Economic Analysis, and you can check out the GDP numbers there. lifespans, instead of growing at 4.2%, grew at only 2.3%. In 2000, you were likely to live to be 70, you were on average living to be 76.8 years. Now in 2009, you went to 78.5 years in life expectancy, which once again, the lifespans grew, but at a lower rate, 2.3% instead of 4.2%. The size of government. This is really the reason why things have slowed down, because the government has gotten bigger. Instead of 7 departments, we doubled the number of federal departments to 15. Our federal budget went to $3.5 trillion, which means that we can't even count the amount of dollars our government is spending in the millions or even in the billions. We have to go to the trillions now to assess what our federal budget is. And by 2009, the government was spending 20% of gross domestic product as opposed to only 2% a century earlier. The national debt was $13.5 trillion back in 2010, 40% of our economy, not the 5% of what it was a century earlier. And another thing to look at, another reason why things have slowed down, is because the gold standard doesn't exist. So we have much more inflation. As you saw with the numbers, we have much more inflation because we don't have a gold standard to control inflation. We have a central bank that devalues the money now. We have an income tax that confiscates the wealth of the people, so there's less investment in economic growth. And we have an estate tax also, which does the same thing. Whenever you take resources from the private sector and you transfer them to the public sector, they are going to be allocated less efficiently, and you will get less economic growth and prosperity. So are we better off in terms of the level of standard of living we have? Yes. But in terms of how much we are progressing, we are far worse now than we ever were. And you can link that to the growth of government. Thanks for watching. Please subscribe to my YouTube channel and Twitter page, Libertarian Black Man. Share this video. Purchase the book, Say No to Big Government, which lays out the case for how we have gotten into this situation, not just talking about the gold standard and central bank, but other government programs and regulations and taxes that have interfered with our economy's ability to be more productive. And the book is on Amazon for $18, and hope to I definitely appreciate you watching this video, and we hope to see you in the next one.